You're listening to QSBS Solved, where we share insights for founders and investors looking to maximize their business's growth, exit opportunities, and tax savings. Our team at QSBSrollover.com offers specialized services to help you benefit from owning qualified small business stock. Our podcast guests are leaders in their respective fields and work on every side of the startup journey to help founders and investors win. The ideas and opinions shared here are not investment, tax, or legal advice. Reach out and we'd be happy to connect you with a qualified advisor or tax counsel. For now, enjoy today's episode. Hey everyone, welcome back to another episode of QSBS Solved. I'm here with folks from Complete Advisors. I have Mr. Evan Levine, Mr. Nainesh Shah, who are here to talk about valuation services. We have talked about valuation a little bit on past episodes when we had Mr. Dan Iman from Meld Valuation on, but wanted to get additional perspective and really think a little bit more deeply about at least what I think of maybe the three main moments where startups or a founder might consider valuation services need a valuation. So that's the start of the company, maybe establishing the cap table initially, raising capital, maybe raising larger rounds of capital, say seed, Series A, B, C, and then exiting your business at the end. So anytime that business changes, you might need valuation services. So we're glad to have Evan and Nainesh here to speak to that. And Evan, why don't you give just a little bit of introduction and to both your firm and to yourself?
Sure. Thank you, Brady. Great to be with you today. So by way of background, our firm was founded in 2019. Nainesh and I are co-founders. My role is head of engagements, which is essentially business development, relationship manager. And Nainesh is our head of our valuation department. He's our lead analyst, and he heads up all the valuation analysis and report writing and so forth. When we started in 19, our focus was mainly on estate planning, valuations for gift and estate tax planning and transactions. But it's timely that we're on the show because more recently, we've been increasingly receiving requests for valuation reports from founders and entrepreneurs. And like you said, throughout the life cycle, there's a lot of reasons why founders and entrepreneurs would need or want a professional valuation report. I'm going to turn it over to Nainesh and talk a little bit more about the back office and our methodology and our approach to valuing startups and startups for founders and entrepreneurs.
Yeah, thanks, Evan, and thanks, Brady. Really appreciate getting us on the podcast. We can definitely talk about what we do and how we do it as we go into this conversation. But we as a firm, have a special affinity towards company that has some kind of a technological edge, or they fall in the technology bucket. Because my background, I worked as a portfolio manager for 25 years on Wall Street, and I spent a lot of time analyzing tech companies, and so understand how one goes about it and what's involved and where to focus when you're valued.
Yeah, and I thought it was interesting the way that you framed up valuation, how you think of maybe two separate instances where valuation may be needed and who that valuation is for and what it's trying to accomplish. Maybe you can dive in here at the start and talk about how you determine what services someone needs based on where that number, that valuation is going and what purpose it's actually trying to serve.
Yeah. I can start, and Evan definitely,
Sure.
You are always good with this type of thought process. All valuations start with, if we get a call from a client that they need a valuation, the first question that we ask is, what is the purpose of this valuation? Purpose of the valuation drives how do you go about it. That also drives what the valuation report is going to look like. Some reports, we put into two buckets, and Evan definitely can add more color to that. The two buckets are, is it for IRS or is not for IRS? Well, Evan, why don't you talk about that first, and then I can go into
I'd like
what
to
you
ask
do.
that question first. because if the report is going to be mailed to the IRS or it's being held in a file for tax purposes, it has to look a certain way and it has to meet certain requirements. NACVA has standards for valuation reports, and those standards incorporate the IRS requirements, which include different methods of valuation and economic analysis and industry analysis. These reports can be 60, 80 or more pages with a lot of footnotes and so forth. So that's the first question. Is it for the IRS or is it not? Regardless, if it's tax related or non-tax related, the valuation process is still the same in terms of the methods and the best practices of valuing an operating business. It's just the report is going to look different. So that's the first question. And then we've done reports that are just for your eyes only, where an owner just wants to get a sense of what the value of the business is to use it as a negotiating tool. So there's nothing to do with the IRS, or it could be for some other legal or official purpose beyond QSBS. It could be a divorce or a shareholders agreement or an immigration. There's so many reasons why you'd want a valuation, but that's generally how we think about it. And then the next process is the next step in the process is for us to gather information, understand again the purpose of it, and then go forward with the engagement and prepare the appropriate report.
And also, so what also happens is if you're dealing with startup, or depending on what stage the business is at, your thought process on what method do you use differs. So generally speaking, there are three broad approaches one can take to value a company. It can, so three approaches are income approach, market approach, and asset approach. And you can use either one or all three in some combination. And this is by IRS requirement, you have to look at everything. And then analyst uses their own judgment on what method to focus on or what combination of methods to focus on. Going back to the concept of the startup or early stage company, usually they don't have significant revenue. You are projecting future using this DCF or some kind of a discounted cash flow method, and a lot of subjective information gets in, and the analyst knowledge about the industry is critical.
So you mentioned the three different, sort of inputs for valuation. There's like sort of the income approach, market approach, asset approach. At the earliest stages of a company, there may not be any revenue, there may not be any material assets. You're really just an idea and a dream. What does valuation look like at the earliest stage of a company?
Yeah, that's where a lot of industry analysis comes into play. Understanding the value of the idea, value of the management team, and what's their background. So we do a lot of when we analyze entity, we really go deep. We try to understand the history of the business, understand what is the management bringing to this business, and then try to understand the market. So industry analysis becomes critical. We analyzed a company recently, early stage startup, at the crossroad of marketing and AI. And now you really have to project how things going to play out. And look, this is where science meets art in valuation. There is a fundamental concept of valuation, which is looking at all these different aspects of numbers, meaning revenue and margin and expenses and balance sheet and all that. But then there's a hard aspect of the valuation is how is this going to play out for this particular company? And that's where we have to do thorough research on the industry and then try to identify what numbers we can use for future projections.
Yeah. Nainesh, do you want to talk a little bit about optionality valuations, like similar to pharmaceutical trials, and how you think about that?
Yeah. So some companies, there are different ways to think about. First thing you're doing in a startup where it doesn't have a lot of asset, it might not have comparable companies. It might, but might not. what you're trying to establish is, can you project revenue with comfort? And if you can project revenue with comfort, then there is not much, then you use whatever growth rate that you are thinking about, and then you start projecting from that. But if you can't do that, then you have to somehow bring in the option valuation into play. And what I mean by option valuation is, think of stock option. You have a choice of buying a stock. You have a right to buy. You have option not to buy. And that's the same thing about revenue. Is this revenue going to materialize, or it might not materialize? And how can you compute that value or the probability or the optionality? And that can be used for valuing startups which have completely new industry focus, or startup or companies that have a volatile revenue. And I'll give you an example more from larger business, but we came across a company that has that supplies services because of the government contract for storm related activities. Meaning, storm happens, they come and help cleaning and servicing the area. Now, storms are not predictable easily, so you have to think of that. And then the contracts are not easily predictable, so you have to think of that and to bring the valuation into it. Revenue need to focus.
I'm sorry, did you have any thoughts on that, Brady, or questions?
Yeah, I was thinking, it sounds like you can sort of work backwards from a number in some scenarios, but you have to have the right fact pattern to back that up. And that's sort of what the research portion of what you're doing is, correct? Because very often I'm sure founders may come to you and say, oh, our business is definitely worth X number. And say, well, okay, pump the brakes. There's this factor, that factor. And we need to be able to justify all of this, correct?
Yeah, you do absolutely have to justify, because you have to expect that at certain point you'll be in front of IRS, and IRS is going to question you. And can you support your thought process with those questions? So yes, everybody has a number in mind, and they want you to hit that number, but they give us enough leeway to explain ourselves. They are not going to say, oh, my company is $10 million worth. Why are you valuing it $5 million or $15 million? They are comfortable because we come from independent background. We are not connected with anybody directly. And then we use our own, and we have the beauty with us, or generally any valuation analyst, is they have a bigger perspective. Founder or startup might have one narrow focus where they know their business and their business ancillary to them. But we have a much bigger view on the world. So we bring in all those aspects.
Another thing, Brady, that's, I think, very interesting is, so we have the three known methods, IRS accepted methods of valuing a business: the market, the asset, income. But there's another method that, ironically, when Nainesh was a portfolio manager on Wall Street, he was one of the thought leaders to introduce a certain method at that time that was used to value Apple. And he was kind of at the forefront of this. And now you see it in a lot more places. It's called CBCV, customer-based corporate valuation. And it's a way of, whereas the other methods are predominantly, you might say, a top-down approach to looking at a business. This is more bottom-up, where you're starting not with the income, not with the assets, not with the comparables, but you're starting with the customer. Each customer has a certain value. And if it's a recurring model where the customers are on some type of monthly recurring subscription model, you could value that company using this method, and it could increase value significantly. And it's something that I think those that are thinking about exit should incorporate into their thinking when they do their exit readiness valuations.
Yeah, and sometimes, although they might not have a direct subscription model, but you can somehow mold into that subscription model. So when I started thinking about Apple as a subscription model, they didn't, you don't buy iPhone. Generally, at that moment at least, you didn't buy iPhone as a subscription. You bought as a unit. But when you try to figure out their customer base and how sticky their customer base is, then you can try to compute what is the average revenue per year this customer is bringing to Apple and that.
Right.
And this is in my mind, this is part of the income approach, but it's a different way. And
Different way to income approach.
Different methods. So there are approaches and there are methods.
Right.
Every approach. So income, market, and asset are approaches. And then within each, there are multiple methods one can use. And you can use this particularly when you're trying to come up with a higher value and you're trying to exit and you want to, it's some M&A transaction is trying to happen.
And Nainesh, back when you started, it was mostly a technology approach, but now you see it everywhere. You see the gym memberships, they want it recurring, and the electrolyte drinks that you put in your water, and everyone wants recurring revenue. And,
monthly shaving club,
monthly, that's right.
It's
everything.
There's a lot of this now.
It's not easy to pull off, but if you could do it, I think you have a legitimate way of approaching the valuation if you have a certain amount of recurring revenue, which is beyond just the technology sector. You see it everywhere. And
right, because you get your recurring revenue divided by your
acquisition
customers,
cost,
and then
retention rate.
Retention rate, and then you can pretty easily map that number of growth, right?
That's a simple way to think about it. Absolutely.
Yeah.
And certainly Amazon makes it possible. I mean, you can buy a mattress on subscription, right? Like every 10 years, send me a new mattress. It's an interesting way to think about valuing a business. And to me, that's, interesting in the context of maybe you have a little bit lumpier sales cycle. And so maybe growth is a little bit lumpier and allows you to kind of level things out. If you think of, hey, what are these three inputs? Cost of my product, number of customers buying the product, and then retention of the customer.
It's again, what you were saying earlier, a founder or owner of a business has some number in their mind, but their numbers, what number they have in their mind depends on purpose again, right? If they want to qualify for QSBS, they have a certain number. If they want to sell the company, they have a certain number in mind.
Right.
And that number changes up and down depending on how it benefits. And so you can play around with those type of ideas with good justification.
Yeah, even in tax planning, if it's for a gift, they want the value to be as low as possible. But if it's not a taxable estate and the heirs are selling the business, they want it to be higher. And I always ask Nainesh about that, and he reminds me that it's not just science, there is art, and there's always a range. It just has to be reasonable. You have to have a narrative and a story and financials that could defend it. And there's a range within reason.
Right. Right. Because someone might say to you, hey, the value is the value. And so how is there a dynamic range based on what we need it for? Like, you can't say my business is worth $1 million when it helps me and 10 million when it helps me. It has to be a number. But what you're describing here is that there is no, it's not a public company. There is no sort of quote unquote perfect weighing mechanism for understanding the value on any given day. And so, it is a range.
Absolutely.
And there are a bunch of different methods. There's one method that gets you at the low end of the range that's completely justifiable and reasonable. And there's another method maybe that gets you at the upper end of the range.
Yeah.
Again, justifiable and reasonable. But the client may handpick one number from that range that fits their situation.
But again, it comes back to purpose. So if the report's being mailed to the IRS, it's one number. If it's an exit readiness report, it's often a range. And so
but the other thing is that all of them have to have similar thought process. So if you're doing valuation for QSBS, or you are doing valuation for 409A, or you are doing valuation for trust and estate, if those are all done for the same company, similar time frame, then thought process has to be similar.
It should be similar.
Do completely different valuation for different things. The other thing that we didn't touch on, Brady, is the date of valuation is critical. So in tech sector particularly, it can be quite volatile. So back in February of this year, valuation was down because of whatever was going on in the broad political arena and tariffs and all that. Suddenly, valuation dropped for just 1 month, and then it came back. The other thing is where this business is located. When we talk about businesses, we talk about US businesses, but some might have international exposure, and that can be valued. That values differently than US businesses. So that all kind of comes into play, and that's why valuation seems easy, but it's complex.
Also, if interest rates dramatically change, discount rate could change. So 6 months or a year could make a big difference. Pre-COVID, during COVID, valuation date is the purpose and the date are critical. And then the last thing that Nainesh teaches our sales team is the sanity test, which is a real practice in valuation where you go through this whole report and you go through all these methodologies and you come up with a number, and then the sanity test at the very end is, does it make sense? If somebody walked to you in the street and offered you this much for the business, is it completely out of whack? Is it way more or way less than it would be? So, the sanity test is something that we usually do at the end, right? Nainesh, after all the quality.
Yeah, generally it has to make sense. Is somebody going to buy you for that price? Is the underlying concept is a hypothetical buyer and hypothetical seller, both having equal information, and at what price will they transact? That's the underlying definition of fair market value, which is what IRS wants.
And if there's a valuation for a gift transaction, and then the business sells for a wildly different amount 6 months later, that's going to need to be explained and justified. People overpay and underpay for businesses all the time. So the valuation doesn't necessarily reflect what someone's going to pay for it. But the most important thing is the narratives. And
as a founder, you want to also you want to have it as a tool to back you up in your negotiation as well. And so whether that's with potential investors or someone who's ultimately trying to purchase your business, you can create your own narrative as a founder about the value of your assets. And if you have a valuation by someone trustworthy and with a good track record that backs up that narrative, then, it's, some buyers will react differently. They say, well, one way or another, but at least you have something that you can put behind your narrative.
Yeah. The part of the pitch deck that mostly the startup or founders or young businesses have, part of that pitch deck is numbers. And those numbers are really for the valuation.
Yeah. Now,
of course.
Most of our work comes to us through advisors, attorneys and CPAs and wealth advisors. Occasionally an owner or founder will come to us directly. But one thing we don't do when working through advisors is advise them whether they need the full report or not, because we've heard in some cases, there's a lot of ways to get a valuation. There's websites that will do it. There's CPAs that could give you an Excel one-page spreadsheet. We do the full report and we follow all the standards. And in some cases, the advisor says they don't need the whole thing. In some cases, they do. So we're not going to really opine too much on whether or not they need it, but if they conclude they want the full report, then we could do it.
Yeah, it's been good to talk through some of the models and sort of for people who aren't familiar with valuation, the different methodologies and strategies that are used. It's helpful to have a framework for that. Something that we talked the last time we had a valuation episode, a question that I asked was, how do you, when someone knows that they need valuation services or business advisory services like this, how do they know who to choose? What should they be looking out for? Whether they go with you guys or someone else? Maybe what are a few pieces of advice in terms of, here are the green flags, here are the red flags when choosing someone trustworthy to work with?
That's a good question. So in the world of valuation, people specialize. They specialize by type of valuation that they do, meaning is it 409A? Is it focused on trust and estate? Is it focused on divorce or separation? So that's one way to think about where do you spend most of your time as a valuation person. The second way to think about valuation analyst is the industry. Where do you spend most of your time? Which industry do you focus on? So it could be medical practices. It could be automobile dealership. It can be some restaurant, whatever, or technology companies. So you want to find out that. And then you do want to understand how sometimes some analysts don't do this full time. They have CPA practice or something similar on the side, and they do valuation as an ancillary. Some companies do valuation as a dedicated service. So you want to identify all of that. Evan,
Yeah.
you have thoughts?
I would say I was surprised to learn when we started that the IRS doesn't have any in terms of how they define a qualified appraiser or any tax authority or legal authority. A qualified appraiser does not mean that they have certain education experience or designations or this or that. A qualified appraiser means that the person signing the report has sufficient experience historically in valuing whatever they're valuing. So if it's a business, you want an analyst that has valued many businesses, or if it's IT, that has valued IT. If it's real estate, you want someone that values real estate. If it's jewelry. So the first thing is, are they qualified? Do they have deep experience? In our case, it's businesses, particularly technology businesses. We don't do real estate or other tangibles. And then beyond that, it's just like anything else, getting on the phone and asking the questions, how much experience they have, how do they think about it, how are they going to charge, how long is it going to take, what's the communication flow going to be like? And, like anything else, you ask around and maybe interview a couple and make a decision,
Well, I imagine experience and speed are two important factors. I know that your team can work extremely fast as well, which I've heard anecdotally. So that's I think would be important.
Yeah. Although
it comes up, generally speaking, valuation takes a lot of time because collection of data is one component, which, if the owner of a business or a founder is not organized, then we have to kind of get them organized.
Yeah.
Then you have to analyze the data and write a report. And those are three big buckets. And we can shrink them as necessary because sometimes you need to do something fast.
Yeah. I mean, good valuation work does take time and you need to be thorough, but there are times where time is of essence and it just has to be turned around. A lot of analysts will factor that into their pricing and say it's typical is 8 weeks or 4 weeks, but if you need it in a week, it could be, there could be a higher fee because they have to put other projects aside. But, it's worth checking around with the view and, getting the CV, which shows the history of, what they valued and, designations you might want to consider, whether it be, CFA or CVA or what are the other ones, Nainesh, that you
ASA,
and
then AICPA, which offers CPAs. They have a designation valuation also.
Yeah, and like Nainesh said, some CPAs do valuation work, but you want to be careful and make sure it's not just something that they're dabbling in. Bigger firms will do it, but they could be very expensive. So.
Sure.
Different ways.
Yeah. Well, as always, for our founders listening, have your ducks in a row early. Try and be as organized as possible, and do your research to start thinking about some of these things before you need it, so that you're not in a crunch where you're having to go with whatever shop you contact first, but also that you're not putting undue burden in terms of timing on yourself and on your analysts. So
that's it.
Really,
this is not the highest priority. For the founders because they are trying to get their business off the ground. So, but if you can do it, I think that more power to you.
I mean, that's the life of the balance of the founder CEO, right? It's like focusing on all the things that we love to do, which is building product, getting customers, talking to customers, building our teams, but also this whole other set of necessities organizing our business services.
And there is a lot of benefit of this. Like, just sticking with going back to the QSBS valuation, you can save multiple $1 million if it is done correctly.
Right.
Yeah. Multiple, I'm talking about 50, 60, $70 million can be saved in Texas. Yeah.
Yeah. It's extremely important what value you're assigning to your stock at different stages in your business, the value of your assets at different stages of the business. For instance, for the 50 million and now for businesses issuing stock in the future, $75 million caps for QSBS,
right?
And the gross asset tests, all of those, if you're talking just in QSBS world, can be impacted by differences in valuation methodology. So yeah, it was great to hear you talk through some of, again, the different methodologies, the different practices and ways to think about coming to that number or that range of numbers that a founder or investor can ultimately use to make the right decisions for themselves. Thanks a lot, Evan. Thanks a lot, Nainesh. Appreciate having you coming and joining.
You. I really appreciate you.
Talk soon. Bye-bye.
Okay.
Thanks for listening to this episode of QSBS Solved. We hope to hear from you soon. Remember that the content shared on QSBS Solved is for informational purposes only and should not be construed as legal, tax, or investment advice. While we discuss strategies related to qualified small business stock, or QSBS, including rollover planning, listeners should consult their own tax, legal, and financial advisors before making any decisions. Laws and interpretations can change. Individual circumstances do vary.